If you've ever bought a piece of equipment for your business and weren't sure how to depreciate it, this video is going to give you a simple way to land on the right method very quickly for just about any asset you come across. We'll cover the three main depreciation methods at a high level, a quick decision guide for choosing between them, and then run a few real assets through it so you can see exactly how it works. And we've put together a one-page version of everything we cover here that you can download using the link in the description, so you can keep it next to you the next time you're setting up a new asset. Quick note before we start, this is the high-level version. If you want to dive into the actual math, the full schedules, and the journal entries behind all of this, we've got a complete series that builds each method from scratch, and you can find the link to it in the description below. But we'll do our best here to cover the concepts quickly and thoroughly enough to give you a solid understanding of depreciation calculations. So let's set the stage with a simple example we'll use throughout. Say a coffee shop, Bright Leaf Coffee, buys an espresso machine for $4,000. They expect it to last about 5 years and to be worth around $500 when they're done with it. That means there's $3,500 of cost to spread out over the machine's life, and the only real question is how to spread it. That how is what we call the depreciation method, and there are three common ones. The first is straight line. This one spreads the cost evenly, the same amount every year. For Bright Leaf's machine, that's $3,500 spread over 5 years, so $700 a year, every year, simple and steady. The second is declining balance, an accelerated method. Instead of an even amount, it front loads the expense, taking bigger deductions in the earlier years and smaller ones later. The asset takes its biggest hit when it's brand new. And the third is units of production. This one ignores the calendar entirely and ties depreciation to actual usage, how many units the asset produces, or miles it drives, or in Bright Leaf's case, shots of espresso it pulls. A busy year means more depreciation, a slow year means less. So those are the three. Now how do you choose? The main decision comes down to one main question. What actually wears this asset out? Is it the passage of time, or is it how much we use it? That single question does most of the work because it splits our three methods into two families. On one side, the time-based methods, straight line and declining balance, where another year going by is what drives the expense. On the other, the usage-based method, units of production, where it's the actual output that drives the expense. So start there. If the asset's wear is genuinely driven by how hard you run it, and most importantly, you can actually track the usage, then units of production is your method. Think of a piece of manufacturing equipment on an assembly line that already counts the units it stamps out. The wear tracks the usage, and the usage is already being tracked, so units of production gives you the most faithful picture without much added effort. But if the asset is really worn out by time, which honestly is most assets, then we move to our follow-up question. Does this asset lose most of its usefulness early in its life and then taper off, or does it stay roughly as useful year after year until the end? If it loses value fast early on, then an accelerated method like declining balance is the better fit, because it front loads the expense to match. Think of something like a laptop or a piece of cutting-edge technology, hugely useful the day you buy it, but quickly overtaken and worth a fraction of that within a couple of years. But if the asset just chugs along, roughly as useful in its final year as it was in its first, then we reach for straight line, the same steady amount every year. And that's the one to default to, both because a lot of assets really do wear evenly, and because, as we talk about in a second, it's simply the easiest to live with. So that's the whole decision guide. Is it usage that wears it out? Go units of production. Is it time? Then ask whether it fades fast, which points to declining balance, or fades evenly, which points to straight line. One main question, one follow-up, and you've landed on the method. Now before we run some examples, one important reality check, because a guide like this can make the choice look more clear-cut than it really is. Two things to keep in mind. First, this guide is about your book depreciation, the methods you use to faithfully represent how an asset gets used up on your financial statements. It is not about your taxes. For tax purposes, you don't really get to pick at all. You follow the rules laid out by the IRS. which in the United States generally means an accelerated system called MAKERS, regardless of what you landed on with this guide. So this is the tool for your books, not your tax return. And for most businesses, those two are separate calculations. And second, in the real world, simplicity wins more often than the textbook would admit. Straight line is the default for a huge share of assets, even some where you could make a case for another method, simply because it's predictable, easy to budget, and easy to audit. So think of this guide as pointing you toward the most faithful method, but don't be surprised when the practical answer, especially for a small business, is just to keep it simple with straight line. With that in mind, let's run 3 quick assets through the process, and you'll see both how fast it goes and where that real-world judgment comes in. First, Brightleaf's espresso machine. So what wears it out, time or usage? You could argue usage. It's the shots pulled that really wear the machine down. But would Brightleaf realistically track every single shot just for depreciation? Probably not. And the machine is roughly as productive in year 5 as it was in year 1 anyway. So we fall to the time side, and then ask, does it fade fast or stay steady? And we just answered, it stays steady. So we land on straight line. Next, a delivery van for Brightleaf's catering orders. Same first question, time or usage? Here usage has a real case. A van driven 40,000 miles is genuinely more worn than one driven 5,000. And mileage is easy to track. So the most faithful answer is units of production, by the mile. But, and this is the honest part, in practice most businesses put their vehicles on a straight line schedule anyway, purely because it's simpler. So this is the perfect example of the gap between the textbook faithful answer and what actually happens on most real sets of books. Both are defensible. The guide points you to units of production, simplicity often points you to straight line. And third, an office laptop. Time or usage? Time. Nobody's depreciating a laptop by keystrokes. So we move to the follow-up. Does it fade fast or stay steady? It fades fast. A laptop loses a big chunk of its real value in the first year or two as software demands grow and newer models arrive. So this one points to an accelerated method, declining balance. Though once again, plenty of businesses would just run it straight line over a few years and call it a day. So there you have it. 3 assets, each through the guide in under a minute, and each one also showing that little bit of real-world judgment that sits on top of the clean decision rule. And if there's one big takeaway to leave you with, it's this. Depreciation isn't about changing what an asset costs. It's about telling an honest story of when that cost is used up. The method just shapes the timing of that story. Whichever you choose, Brightleaf still spent $4,000 on that machine. The only question any of these methods answers is how to spread that cost across the years the machine actually earns its keep. So if this was helpful to you and you want to go deeper, this video is the high-level companion to our full series on depreciation methods, where we build each of these from scratch, work through the real schedules and journal entries, and look at how tax depreciation works. You can find that series and a lot more finance and accounting material over on our website, and the link's in the description along with that one-page reference guide. So thanks for watching, and please drop any questions in the comments and we'll help however we can.